Have you ever wondered why the Indian rupee continues to fall against the US dollar? How does this impact not just our economy, but also your everyday life? Whether you're buying groceries, filling up your car with fuel, or planning a trip abroad, the rupee's decline has a direct effect on you. In today's video, we're going to dive deep into the reasons behind this depreciation, exploring both the global and domestic factors that contribute to it. We'll also discuss how this impacts your purchasing power and the steps India can take to stabilize its currency. Stick around until the end, and you'll get a clear picture of why this is happening and what can be done about it. Let's get started. To understand why the rupee is falling, we need to first understand how currency exchange works. Currency exchange rates are determined by the supply and demand for a country's currency in the global market. When demand for a particular currency is high, its value increases. On the flip side, when demand is low, the currency weakens. The US dollar is the world's reserve currency, meaning most international transactions, especially in key commodities like oil and gold, are conducted in dollars. So when countries like India import goods, say crude oil or electronics, they need to pay in dollars. This creates a constant demand for dollars. For example, India buys a large amount of crude oil, and since oil is priced in dollars, India must exchange its rupees for dollars. When there's more demand for dollars than for rupees, the rupee loses value. This imbalance in supply and demand plays a major role in the rupee's depreciation. But currency exchange doesn't happen in isolation. There are a host of other factors influencing the value of the rupee, and we'll get into those next. India has been facing a growing trade deficit, meaning we import more goods and services than we export. Key imports such as crude oil, electronics, and gold take a large chunk of India's foreign exchange reserves. As these goods are priced in dollars, it increases demand for the US dollar, putting downward pressure on the rupee. Take oil, for example. India is the world's third largest oil importer. When global oil prices rise, the country's import bill increases significantly, and so does the demand for dollars to pay for those imports. This higher demand for dollars results in the rupee losing value. Although India's export sectors like IT and pharmaceuticals have seen growth, they still aren't enough to offset the rising costs of imports. This trade imbalance is one of the key reasons why the rupee keeps weakening. Another major factor contributing to the rupee's fall is the US Federal Reserve's monetary policy. When the US raises its interest rates, it makes dollar-denominated assets more attractive to investors. Higher interest rates mean better returns on investments in the US, which draws foreign capital away from emerging markets like India and towards the US. This phenomenon is called capital flight. As investors move their money to the US in search of higher returns, foreign investors start selling their rupee-based assets and buying US dollars. This further increases the demand for dollars and puts more pressure on the rupee, making it weaker. The US Federal Reserve's actions are closely watched by global investors, and any tightening of US monetary policy leads to a ripple effect on emerging market currencies, including the Indian rupee. Inflation within India also plays a crucial role in the rupee's depreciation. If inflation in India is higher than in the United States, the purchasing power of the rupee declines. This, means that the rupee buys fewer goods and services in India compared to the dollar. For example, if domestic prices for goods and services rise faster than in the United States, the rupee weakens further. When people's purchasing power is eroded, the economy slows down. Higher inflation coupled with slow economic growth can cause investors to lose confidence in the Indian economy, pushing them to seek safer assets like the US dollar. A lack of strong economic growth, especially in manufacturing and industrial output, also worsens the situation. With a stagnant economy, the demand for rupees is lower, and the currency weakens. Global events like the ongoing Russia-Ukraine conflict also have an impact on the rupee. During times of geopolitical uncertainty, investors tend to flock to safe haven assets, and the US dollar is one of the safest bets. This flight to safety results in the weakening of currencies in emerging markets, including India's. Uncertainty in the global economy, whether political or financial, triggers a sell-off in riskier assets, leading to further depreciation of the rupee. The weakening of the rupee doesn't just affect the economy at large, it impacts you directly. Let's look at a few examples. 1. Fuel prices. Since India imports oil in dollars, rising oil prices lead to higher petrol and diesel prices. This translates into increased transportation costs, and everything from food to goods becomes more expensive as companies pass on the higher transportation costs to consumers. 2. Costlier goods. Many everyday goods, from electronics to luxury products, are imported. With the rupee weakening, these imported items become more expensive. So you might find yourself paying more for things like smartphones, laptops, and household electronics. 3. Education abroad. For students looking to study abroad, the depreciating rupee makes education costs much higher. The tuition fees, living expenses, and travel costs increase as the value of the rupee drops, making it harder for families to afford foreign education. 4. Travel costs. Planning a vacation abroad? Well, everything from flights to hotels will cost more as the rupee weakens. The value of your money decreases when exchanged for foreign currencies, which can significantly impact your travel budget. While Indian exporters might benefit as their products become cheaper on the global stage, for the average consumer, a weak rupee makes life more expensive. To stabilize the rupee, India needs a multi-pronged approach. 1. Reduce import dependency. India is working on reducing its reliance on imports by focusing on domestic production, especially in sectors like renewable energy and electronics. This would help reduce the demand for dollars by lowering the import bill. 2. Boost exports. While India's export growth in areas like IT and pharmaceuticals has been steady, there's room to expand across other sectors. Promoting more exports can help bring dollars into the country and improve the balance of trade. 3. Attract foreign investments. By creating favorable policies and an attractive investment climate, India can encourage more foreign direct investment, which would help stabilize the rupee by increasing the supply of dollars in the economy. 4. RBI interventions. The Reserve Bank of India often intervenes in the currency market to stabilize the rupee. This is usually done by selling dollars from India's foreign exchange reserves and buying rupees. However, such interventions are often temporary and do not address the root causes of depreciation. The falling rupee reflects a mix of global and domestic challenges. While some factors like global oil prices and geopolitical crises are beyond India's control, others like boosting exports and reducing dependency on imports are within our reach. Now it's your turn. What do you think India should prioritize to stabilize the rupee? Let us know in the comments section below. If you found this video informative, give it a thumbs up, share it with your friends, and don't forget to subscribe for more insights into economic trends that shape our world. Thanks for watching and see you next time.